Rising interest rate can soon set up a bond for homeowners who has a fixed payment variable mortgage. One of the biggest banks in Canada, RBC, is projecting more than 80,000 homeowners can have their trigger rate take place after a few more interest rate hikes. And it's also said that the average monthly payment can increase by more than $200 per month. In this video, I will explain what is a trigger rate and why a lot of homeowners are worried about it. And if you ever encounter a trigger point, what are your options moving forward? Hey, it's Cody A here. On this channel, I focus on explaining complex personal finance and investing terms in simple words. I hope through these videos, you can gain some knowledge and help get you one step closer to your own version of financial freedom. So let's get right into it. And here's how trigger point works. Your mortgage payment consists of two parts. A part of it goes to the interest payment. The other part of it goes to the principal pay down. When interest rate is increased to the point where the interest payment is no longer covering the interest being charged, the interest is deferred and added to the principal amount. When the outstanding principal balance, including the deferred interest, rose to the point where it exceeds the original principal amount, which is the amount you originally borrowed, and that is the trigger point. So I know that was a mouthful of words. What it basically means is that the banks want to make sure your monthly payments able to cover the increase in the interest payment and also having enough to pay for the principal pay down. So how do you calculate your trigger rate? By multiplying your monthly mortgage payment by the numbers of payments per year and divided all that by the outstanding mortgage balance. So if you have a mortgage balance of $500,000 and your monthly mortgage payment is $2,400, if you pay 12 times per year, you times the $2,400 by 12 times per year and divided all of that with your mortgage balance, which is $500,000 in this case, your trigger rate is 5.76%. At the time when I'm filming this video, the prime rate for most Canadian banks are 5.45%. And on the other hand, the Bank of Canada prime rate is only 3.25%. Now, I know what you're thinking, Cody, your trigger rate is 5.76%, and then the major Canadian banks rate is 5.45%, and the Bank of Canada's rate is 3.25%. This is so confusing, and I totally understand because each bank has a different way of calculating your trigger rate, and the trigger rate was decided when you first sign up for the mortgage. So the best way for you to find out your trigger rate is either go back to your mortgage document and find out what is the trigger rate, or give your advisor a call in person and find out exactly what's your trigger rate and what are your options from there. So you might be asking, why does the lender have the trigger rate set up? This is to ensure the amortization does not go beyond the original amortization within the criteria in which you got your mortgage. And all these words just means that if you agree to pay down your house in 25 years or 30 years, the banks want to ensure you can do that with the rising interest rate. So here's a $1 million question. So what are your options if your trigger point is triggered? And your first option is to increase your monthly payment so that your increased portion of your interest payment will be covered by the increased monthly payment. Second, you can switch your fixed payment variable mortgage into a fixed rate mortgage. This option will lock you in a new monthly payment, most likely to be higher than your current ones. The great thing about this option is that now that you're locked into a fixed rate, you basically lock in your payment for that fixed term so that you can weather the upcoming interest rate hike without worrying about the trigger rate. And the third option is pay up a lump sum into your mortgage balance. When you're paying a lump sum, you are reducing your mortgage balance. If we come back to the trigger rate calculation, when you reduce your mortgage outstanding at the bottom here, then your trigger rate will go up. And this way you can weather potential interest rate hike in the future without revisiting or increasing your monthly payment. So your next question might be, how do we move forward from here? There is certainly going to be some level of pain in the real estate market. And every one of us has a different mortgage outstanding and a different mortgage payment, so we all might have different trigger rate. Instead of waiting for your bank to call you and you're losing sleep at night, It's better to be proactively reach out to your advisor and find out exactly what's your trigger rate, how far away you're from your trigger rate, and what are your options once your trigger rate is hit. And here's the most important part of the video. The change in the real estate price might not cause you to lose your house, but if you cannot afford the monthly payments, it might cause you to lose your house. And since the pandemic in 2020, the housing price across Canada has increased substantially. There are only a handful of times where Canadian real estate market pulled back more than 10% in the last 30 years. And the first one is between 1989 to 2000, where the market slowly pulled back for 20% when it hit the bottom. And the second time is between 2007 and 2009, where the entire Canadian market pulled back 20%. And the third mild pullback we have is between 2017 to 2018 of 3%, when the government introduced the foreigner buying tax. Since the pandemic in 2020, the Canadian house price has substantially increased up until March this year. And at the time of filming this video, which is September 2022, the housing price in Canada has adjusted for about 15 to 30% in the residential side. As Canadians, we did not experience the substantial pullback like what the US market had for the last 30 years. So a lot of Canadian real estate investors are not fully prepared for this. And as you might already guessed it, the price moving forward might be fluctuating, but it's really hard to predict the exact price movement. Instead of focusing on the real estate price movement, we should focus on what we can control, which is the cash flow that required to pay down all these monthly mortgage payments. Do we have enough cash flow to pay the mortgage payment if our trigger rate was hit? And this is the time where you want to make sure that you set aside additional reserve funds. And just in case your trigger point was hit, your mortgage payment have to be increased. If you enjoyed today's video and you found any value from it, don't forget to hit that like button. And if you want to stay up to date with any other investing videos that can help you achieve your version of financial freedom sooner, and consider subscribing to this channel. And I will see you in the next video. Say yeah.